Ever since it spun off and went public back in 2021, Jackson Financial's been one of those stocks that really divides people. It's a fascinating puzzle. You look at one set of numbers and you see this incredible story of shareholder returns. But then you look at another and it paints a picture of some pretty serious risk. So today, let's try to unpack that puzzle.
Okay, so let's get right into it. The big question for anyone looking at Jackson or JXN is really simple. How on earth can a company that generates so much cash and gives so much of it back to shareholders trade at such a stubbornly low price? What's the catch? What is the market so worried about? That's what we're here to figure out.
So to really get what's going on, you have to look at these two totally conflicting pieces of the puzzle that investors are staring at. On one hand, you have a capital return story that's frankly almost impossible to ignore. And on the other, a valuation that just screams, "I don't trust you." First up, let's talk about the cash. Since becoming its own company, Jackson has pumped over $1.8 billion back to its shareholders. And we're not talking about some tiny dividend program here. This is an aggressive central part of their entire strategy. For an investor, that's a huge signal of financial strength and confidence.
Now here's the other side of that puzzle. Despite all that cash being returned, just look at this valuation. JXN is trading at just over 4.5 times its forward earnings. Now compare that to a major competitor like Equitable, which is sitting at almost 9 times. The market is clearly, and I mean clearly, applying a massive discount to this stock. The real question is, why? And the answer to that why lies right at the heart of the business itself. See, Jackson's model is really a tale of two different operations. One is this massive, really profitable legacy business, and the other is where the company is trying to build its future. To solve the puzzle, you have to understand that first part.
And that legacy business, it's all built on something called variable annuities, or VAs. For decades, this was Jackson's bread and butter, and they are incredibly profitable. They generate huge amounts of fee income. But, and this is a big but, imagine promising a retiree a certain level of income for the rest of their life, no matter what the stock market does. Those guarantees are super valuable to customers, but they also expose Jackson directly to the wild swings of the market.
And all that market exposure creates what is basically an accounting nightmare. This is so crucial to understand. The company's official, by-the-book, GAAP earnings are just wildly volatile. That's because of how they have to account for the complex derivatives they use to manage all that market risk. Management says, hey, all that noise hides the real story. So they ask investors to focus on what they call adjusted operating earnings, which strips out all that market craziness and shows a much more stable, boring picture of profitability. And this right here just perfectly shows you the problem. I mean, look at these swings in their official net income. A profit of $6.2 billion in 2022, then fast forward and they post a loss of $1.6 billion in just a single quarter. For a lot of investors, that kind of volatility is a massive red flag. It makes the company incredibly hard to analyze, let alone trust.
So, faced with all this skepticism from the market, Jackson decided to make a huge strategic move in early 2024. They put a plan in motion designed specifically to tame this volatility and just make their whole financial story a lot clearer and more predictable for investors like us.
And their solution was to create something called Brook Re. Now, the simplest way to think about this is they basically created an insurance company for their own insurance. I know it sounds a little complex, but it's a really smart move, a fundamental restructuring designed to wall off their biggest risk. So, how does this actually work? Well, the strategy has 3 main goals. First, Brook Re takes all that market risk from those old VA guarantees and isolates it, putting it in its own separate box. Second, doing that creates a much more stable and predictable flow of cash from the main insurance business. And third, the ultimate goal here is to get rid of that crazy GAAP earnings volatility and make the company's true profitability much, much easier for everyone to see. Okay, so now that the old business is de-risked and spitting out more predictable cash, how does that actually turn into value? Well, you can think of it as creating this powerful, self-funding engine for the entire company. And the fuel for this engine is something Jackson calls free capital generation. Basically, it's the cash the business produces after it's set aside everything it needs to run its operations. And as you can see, it's a huge number. We're talking over $1 billion a year.
And management has been crystal clear about what they do with all that capital. Their whole philosophy is to only put money into projects that can earn a really high return. And if those high return opportunities aren't there, well, they have an explicit strategy to just give that excess cash right back to the shareholders.
The result of that philosophy, it's just staggering. The company has bought back nearly a quarter of all its shares that existed when it first went public. Think about that. From an investor's perspective, that's management screaming that they think their own stock is a bargain, and it's a direct way to boost earnings for everyone who's left.
And they are not slowing down one bit. This chart shows a really clear track record. They set these ambitious goals for returning cash, they hit them, and then they raise the bar even higher. For 2025, they're already guiding to another $700 to $800 million. This kind of thing builds immense credibility and signals a ton of confidence about the future.
So, now we have all the key pieces of the Jackson financial puzzle. We get the risk in the old business, we get the accounting mess it creates, we see management's big fix with Brook Re, and we understand the massive cash engine it fuels. So let's try to lay out the final verdict from an investor's point of view. Okay, the bull case is pretty straightforward. The valuation discount is just way too big for a company that generates this much stable cash. The bulls would say Brook Re has fundamentally fixed the business, and those huge buybacks will inevitably, eventually drive the stock price up. Now, the bear case says, not so fast. That discount is justified. They still see all the risk in that giant block of old annuities, they question if new products can grow fast enough to replace the old ones, and honestly, they just think the whole thing is still too complex for most people to bother with. So in the end, it all boils down to this one question. Is Jackson Financial an undervalued cash cow, just churning out billions of dollars that the market is unfairly ignoring? Or is it a melting ice cube? A legacy business that's slowly disappearing, where the only real game is to get as much cash out as you can before it's all gone. So if you're trying to solve this puzzle for yourself, here's what you need to be watching. First, sales of their new products, things like ILAs and FIAs. Is that growth strong enough to replace the old business? Second, the RBC ratio. That's the risk-based capital ratio. Think of it as a key health score for any insurer. You want that number to stay high. Third, are they actually hitting those huge capital return targets? Fourth, watch their favorite metric, adjusted operating earnings, to see if that core profitability stays strong. And finally, keep an eye on the cash they hold at the parent company. That's their safety buffer. These are the numbers that will ultimately tell you whether you're looking at a cash cow or a melting ice cube.